Hello, everybody. I think we'll probably have some stragglers in here, but I want to start by thanking everybody for joining us tonight. Welcome to our quarter three webinar, third webinar in 2022. Excited to share some information with you tonight. Hope you guys are all having a great day. I have been very long-winded in my last couple of webinars, so I promised everybody that I would try and keep it short, sweet, and concise tonight. So I'm going to jump right into it and start rattling off some information for you here. So today we're going to talk about what happened in the third quarter and some of the opportunities we see here in the fourth quarter. And let's go. Hopefully I can change the screen. There we go. Our agenda for tonight, we're going to do a recap of what happened in the third quarter and some of the influencing factors that move the markets. Talk a little bit about inflation, where we've seen interest rates going, what we think the Fed's plan is from here. Talk a very smidge about the midterm elections, and then talk about what everybody seems to be talking about, which is the possibility of a recession, what that means for investors in your pocketbooks. And then lastly, touch on fixed income, which I think is one of the most interesting areas of the market this year. It's been an interesting year up to this point, but I think there's a lot of opportunity there going forward, and that will segue into our guest speaker, Jeffery Elswisk, who is with Frost Investment Advisors. They manage a couple of the fixed income funds in our core portfolios, and he is a trader and analyst on the fixed income side for Frost. And he will shed even more light than I can on the fixed income markets and where we see that going into the end of the year and into the new year. So let's jump into it. What happened in the third quarter? So wasn't a great third quarter, not awful compared to what the rest of the year looked like, but the markets had a good start to the quarter and then not so good finish to the quarter. So what were some of the driving factors of this volatility we saw in the third quarter? So the beginning of the quarter started off with kind of a wishful thinking or hope that the inflation may have peaked and that the Fed might pivot on their rate hike agenda, and we might get news from the Fed that they were planning to slow down or adjust their rate hike policies. And so the market started to rally in speculation of that possibility, only to find somewhere in the middle of the quarter that inflation actually came in a little bit hotter than expected, and the Fed took a very harsh tone saying that they would continue to raise rates aggressively in an absolute war against inflation to make sure that they could take inflation down by any means necessary, which spooked the markets and caused us to fall in the latter half of the quarter, and also sparked fears of a potential recession, or the idea that maybe the Fed actually wants to put us into a recession in order to slow down the consumer, slow down the economy, and use that as the tool to help slow down inflation by any means necessary, was kind of the tone they took. So as you can see, this is on the left-hand side, you have the inflation numbers that have come out throughout the course of the year. And then on the right-hand side, the Fed rate hikes. As you see, inflation has gone up through June. And then while it looks like the numbers start to come down in July and August and September, they were hotter than expected. So we were expecting them to be under those numbers. So when we got some of those numbers, they were not what we were hoping for. And therefore, the Fed came out with a very harsh tone. You'll see on the right-hand side that on July 27th, the Fed raised interest rates 75 basis points. And took a very negative tone on where they would go from there. And then on September 21st, raised 75 basis points again. And then just about 2 weeks ago on November 2nd, they did another 75 basis point rate hike, and also came out and said that they plan to continue to fight this fight against inflation. What that brings us to year to date, and this is a year to date market through the third quarter for the Dow Jones, S&P 500, NASDAQ, and the aggregate bond index, which is kind of an average of the bond markets. As that pink line is the Dow Jones. End of the third quarter, we were down almost 19%. S&P 500 was down close to 25%, NASDAQ down 30%. And then what we're going to talk about a lot tonight is that orange line, which is the aggregate bond index, which at the end of the third quarter was down 15%, which I can tell you, I've been in this business 25 years. There are a lot of people in this industry, in the financial services business, that have never seen a bond market like this. This is a pretty different bond market than anybody has ever experienced before, and with it brings challenges. What has happened since then is a very different story. And so I'll go into a little bit of what we've seen just since October 1st. And this is that same four indexes, Dow Jones on top, S&P 500, NASDAQ, and the bond market since October. And you'll see that we started off this new quarter with a bit of a rally. And some of that was a combination of, again, anticipation that the Fed was going to come out at their November rate hike with a different tone and maybe a slowdown in their interest rate agenda, but also a little bit of a rally because of the quote unquote red wave that people were anticipating, which is the midterm elections potentially showing that the Republicans would take over the House and the Senate. And so a combination of those two things started the market off a little bit hot going into the quarter, only to get to the November rate hike from the Fed, where the Fed came out and kind of squashed all of that by saying that they were going to raise 75 basis points and that they were going to continue to raise interest rates as they continue to fight against inflation and take, once again, a very harsh tone. And so you can see somewhere around November, the markets that had been doing very well started to pull back again, only until the election, where we saw that it wasn't going to be this red wave that everybody was looking for. Markets didn't like that and pulled back again a little bit more until right about here, which right about there is last week. And the reason you've seen this spike recently is that last week we got inflation data, and that inflation data was the first time, I think, all year that we had numbers that came in better than expected, showed potentially that inflation may have actually peaked, or at least we're seeing signs of it coming back. And so it sparked new speculation about the potential for the Fed to maybe raise one more time in December, maybe one more time after that. But you were now getting speculation again that the Fed may be at the tail end of its interest rate hike agenda. And so they may be coming to an end or slowing down here soon, and that maybe we're starting to see inflation start to pull back. So that speculation has sparked this late rally here at the beginning of November. And as you can see, the Dow Jones for the beginning of this quarter is up 17.5%. You have the S&P 500 11.4%, the NASDAQ up about 7%, and the anemic bond market, which is basically flat over that time period. So a bit of a rally going into this quarter here. I'll backtrack. I mentioned that I would talk very briefly about the midterm elections. As I mentioned, there was a little hype and the markets were doing relatively well in anticipation of a red wave coming in. And then the markets hiccuped a little bit when they saw that that wasn't going to be the case and necessarily happen. I heard from an analyst when I was in Denver, and she basically summed it up where she received two emails in the previous week. One email said, "Wouldn't a red wave be great for the stock market?" And the other email said, "Wouldn't a red wave be terrible for the stock market?" And I think there is some speculation that a red wave would be optimistic for the markets and the markets would move on that information. But really all of that is just speculation and really not a driving force for the markets. The driving force for the markets right now is, where is inflation? What is the Fed going to do with interest rates? And are we going into a recession? The whole midterm election red wave noise might have given a little bit of momentum to the market, but that's not what's really going to drive the markets longer term. And so just a blip on the radar, but not something that I think is going to have a big impact on the market overall. We really are mostly focused on, where is inflation? What are interest rates in the Fed going to do? And are we going into a recession? So let's talk more about that. So the recession, that's been the news lately. Everybody asking, are we going into a recession? And if so, what is that going to look like? So let's talk about a recession, what that looks like, and the possibility of one. Some would speculate that the Fed actually wants us to go into a recession or is pushing us that direction to try and slow down the economy, slow down the consumer, and therefore slow down inflation. I think that is possible. That is one of the tools that they could potentially use to slow down inflation. And they did say they would slow down inflation by any means necessary. So what is a recession? So generally, the definition of a recession is 2 consecutive quarters of negative GDP. We got that in the first quarter with a negative 1.4% GDP. In the second quarter, it was negative 0.9%, which by many, they would say that puts us into a recession. However, the National Bureau of Economic Research, their definition, and I quote, is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, what you see on the screen, real income, employment, industrial production, and wholesale retail sales. The reason that they are not saying we're actually in a recession is because a couple of these areas have still been relatively strong, namely real income, unemployment, and industrial production. And so some of those have not shown enough sign of weakness for them to, quote unquote, call the recession. And so they feel like we're not quite there yet, but we may still be heading that direction. As you can see in the third quarter, GDP numbers came out and we actually bounced. We were positive 2.6%. So again, kind of tempering the idea that we are in a recession currently, but there are still lots of fears that we are definitely heading that direction. So what does an economic cycle look like? This screen right here will give you an idea of what the normal economic cycle looks like and where we might be in this, in what phase we might be in. So early on, as you can see on the left-hand side here, it says you get economic activity starts to accelerate, people start to work more, housing activity increases, and the central bank typically starts to ease on policy or lower interest rates. Middle of the economic cycle, you see profit margins start to peak, employment improves, so people are working, making more money, credit demand starts to pick up, so people are borrowing and expanding, and inflation starts to near a target, which is where we want it. Once you get late in the cycle, labor markets start to tighten, so unemployment starts to rise, costs start to soar, so inflation starts to take off, profit margins start to get squeezed, and the central bank starts to tighten. Most people would say that's about where we are right now, with the exception of the labor markets, which have only tightened a little bit, and unemployment is still very, very low. Costs are obviously up with inflation. Profit margins have started to get squeezed, and obviously the central bank is tightening quite a bit. And so that would make us this blue dot right here, the U.S., somewhere in the late phase of the economic cycle. Once the central bank starts to tighten, starts to slow things down, that typically leads to a recession, which is economic activity starts to decline, credit gets pulled away from the system, and unemployment starts to rise. And unemployment is one of those numbers that the Fed has been looking at to say unemployment is still too low. We need that to go up a little bit, which again, kind of leads to the speculation that the Fed almost wants us to head into an economic slowdown or potentially a recession in order to get inflation under wraps, excuse me. Some of the things to think about when you talk about a recession, though, at least from what investors or just business owners in general should be thinking about, is that if you go back to 1950, this chart shows economic expansions and recessions. And what you'll see here is that over the last 72 years, we've only spent about 15% of the time in a recession. The average recession lasts about 10 months and has a pullback in GDP of about 2.5%, while the average expansion lasts 69 months and GDP growth is north of 24%, almost 25%. So the expansions are much bigger than the contractions. And so while recessions are inevitable and part of the process, They're a small piece of what happens throughout the course of economic cycles. And we need to understand that they come, and they're not much fun if you're a business owner or you lose your job, or you lose your business, but they're part of the process, and the expansions can be very healthy and something we should be looking forward to. So what are some indicators of a recession? And what makes us think we might potentially be there? Number one is what's called an inverted yield curve. That's where interest rates on the short end of the yield curve are higher than they are on the long end of the yield curve. The yield curve inverted this year back in July, which gave us our first indication that we might be heading towards a recession. Unemployment is typically another indicator of a recession. As I've mentioned a couple of times now, while it has dropped a little bit, it is still very, very low. And one of the pieces that they say is keeping us from being, quote unquote, in a recession, because employment is still very healthy. Consumer confidence was an area that looks very weak. In July and August, that pulled back quite a bit. So you're seeing a decline in consumer confidence, which is the sign of an upcoming recession. Housing starts, while they have slowed, have still been relatively good. And so that is an area that has not quite rolled over yet. And while leading economic index is another indicator of an upcoming recession, while the growth rate has slowed down, it's still been relatively strong. So we've got 2 out of the 5 indicators that seem to show that we're either in or heading towards a recession, and 3 that are still relatively healthy. So what that means is we're either going to see those start to pick up here soon and roll over as we get closer to a recession. It may mean that we avoid a recession, or it may mean that the recession that's coming might be relatively mild to some degree. This here is another indicator of the likelihood of a recession. This is the New York Fed model of a probability of a recession in the next 12 months. That pink checkered or dotted line is the 30% threshold that is always reached prior to a recession. As you can see on the tail end of this chart, we have had a significant spike in the likelihood of a recession coming. You see this blue line that has spiked really strong here in the last month or so, but it is still underneath that 30% threshold. So while we have spiked significantly that direction, we are not quite there for some of the indications that the recession is inevitable, which means that there is still a chance that we avoid a recession, but we are heading that direction, and the likelihood is becoming more and more likely that a recession is coming to us in the near future. So what does that mean for investors? This is something I talk about a lot. I've never had a chart to show, so I brought this chart up to give you guys an idea of what that means for you and your portfolios and investing your money. Is that typically the market tends to peak 6 to 7 months prior to the peak of the economic cycle. So the blue line here is the markets, the S&P 500, and the teal line is the economic cycle, okay? So what you're seeing here is that the peak of the market typically happens about 6 to 7 months prior to the peak in the economic cycle. So the market, being a leading indicator, is typically starts pulling back in anticipation of the upcoming recession far before the recession actually starts or the cycle starts to roll over. The hardest part about this for investors to understand, and where I think investors make the biggest mistake, is they also don't understand that the market tends to bottom out about 6 to 7 months prior to the end of that pullback in the economic cycle. So as you see here, in this area right here, the market bottoms out while we are still in the middle of that quote unquote recession or economic pullback. And the market starts to take off 6 to 7 months prior to the end. So I've heard it time and time again in recessions where everyone says, I don't understand, why is the market taking off and doing so well when things are so bad? My business is slow. My friends just got laid off from work. The economy seems really, really weak right now. Why is the market starting to take off? Well, the market, again, is a leading indicator looking out to the future, and it starts projecting where the market is going, not where it's been. And so it starts moving prior to the end of that recession or the end of that economic cycle. So where people make the mistake is they get, and if you can see my cursor, somewhere in this area, which is about where I believe we are right now, and they hear all this news of the upcoming recession. And so they want to protect their portfolio and start moving things out of the market in anticipation of this continued weakness in the economic cycle. And so they start making adjustments to their portfolio late, way after the market peak, just before the market starts to turn course, because they're trying to avoid what they think is going to occur during this weakness in the economic cycle. And they end up getting out at the bottom of a market when they should have held steady and stayed the course. So that's one of the biggest mistakes I see people make in this area. And that's where I think we potentially are in this economic cycle. Is we've already seen the market decline over or around 20%, which is technically a bear market. And that puts us down in this area where we've obviously come off the peak. We've pulled back quite a bit. We're starting to see weakness in the economic cycle, the beginning stages or the later stages of that economic cycle, only to potentially go into a recession here soon. But where people are going to make the mistake is we could easily see the market start to pick up and start to take off in the near future in anticipation of the end or the coming recession coming to an end in the near future. So always got to be looking out to the future versus looking at what is happening today. So what do we do as investors when we're heading into a recession? These are some areas to think about when you're investing in the markets. First of all, a lot of these changes we made earlier this year because we thought with the GDP weakness at the first and second quarter that we were already either in a recession or heading that direction. So we started pulling money out of some of our growth names and moving them into value or dividend paying companies. And that's exactly what this chart shows. Typically in a recessionary environment, the more resilient stocks to own are dividend and value companies. And if you're going to own growth stocks, you want to own growth stocks that are large. They have a healthy balance sheet, healthy cash flows, and are going to be able to weather the storm of a recession. Great thing to think about when investing in a recession is think about the things that people are still going to need even if a recession hits. Those are great places to put your money in a recession, and because those are companies that are still going to do well in that weak economic environment. Bonds and the recession. So I'm going to touch on this briefly, and then I'll let our guest speaker kind of take it from there. Bonds are typically a place to hide. They're a safe haven in difficult market environments. As you can see, going back through time, the blue is the bonds and what quality bonds have done during these different time periods, and the pink is the S&P 500. So you go back to 2010, bonds up 3%, while the S&P was down 15. You go to 2011, up 5.5 versus down 18, basically flat when the market's down 12, up 1.9 while the market's down 12. Down 1 while the market's down 10. 2018, when we had the huge sell-off at the end of the year, down 19. Bonds were up 1.6, holding their own in 2020 when the market went down 33. At the beginning of this year, though, one of the changes we've seen and the difficulties we've seen in this market environment is that because rising interest rates are causing the market to pull back, they are also negative for the bond market. So you'll see in the beginning of the year, bonds down 3.3 while the market was down 12, bonds down another 5.6 while the market was down 20. We have the bond markets pulling back at the same time. We have the stock markets pulling back, which has made it very difficult for a balanced portfolio to weather the storm in this type of market environment. Why does that happen? If you don't understand the relationship between interest rates and bonds, this chart shows it relatively well. When interest rates fall, bond prices increase. And on the right side, when interest rates rise, bond prices fall. And the way I like to explain this is that if one of you came to me and purchased a bond a year ago and the interest rate was 1%, and a year later, somebody can buy a bond from me for 3%. Let's say you bought your 1% bond with $10,000, and today an investor can come buy a bond for $10,000 at 3%. Why would the 3% investor want your 1% bond? Your 1% bond is very unattractive to them when they can buy a 3% bond right now. They don't want it. So in order to compensate them for the fact that you have a lower interest rate than what they can get on the open market, you have to take less for that bond. So you might sell it to them for $9,000 or $8,500 or $8,000. You're going to take a loss on that bond because your interest rate is lower than what the current market is offering. So as interest rates go up, your lower interest bonds become less attractive, and that bond value starts to decline. So that is what has happened. We've seen a very big spike in interest rates this year, and you've seen the value of bonds that were purchased previously have started to lose value throughout the course of the year. And that's why it's been such a difficult bond market in 2022. When you put it all together, to kind of summarize where we are today, we obviously have had a very rough start to the year, but we've had a very nice run here in October and November. So the Dow Jones at this point is really only down 7% for the year. It's quite a bit better than where it ended the third quarter. You have the S&P 500 that's down 16% for the year. You have the NASDAQ down 27%, almost 28% for the year. But again, the part I want to talk about a lot tonight, or I want our guest speaker to kind of focus on, is that orange line. That orange line, that aggregate bond index, down almost 16% for the year. So when you have an S&P 500 that's down 16% for the year, and an aggregate bond index, your conservative fixed income investments, that's down pretty much the same as the S&P 500 in a year like this, that's pretty unheard of and something we don't experience very often. But it also provides an opportunity, if you don't look at what happened throughout the course of the beginning of this year and look out to the future, it does provide some opportunities in the bond market that we didn't previously have. I will touch on one of them, and then I will hand it over to Jeffrey and let him kind of take it from there. But this is the yield curve for US Treasuries. If you look at this bottom line here, this is a year ago, and the top line is today. If you look at a 10-year treasury a 2-year treasury a year ago, you bought a 2-year treasury a year ago, it was going to have an interest rate of 0.5%. And a lot of you that are my clients, you probably came to me and said, this is crazy. I'm not making anything at the bank. Treasuries aren't paying me any interest. I'm not making any interest on my money. Well, today, you can buy a 2-year treasury that's yielding almost 4.5%. So interest rates have spiked considerably. They've caused and wreaked havoc on the bond market throughout the course of the year and made it for a very difficult bond market. But at the same time, interest rates have gone up quite a bit, and there's a lot of opportunity to purchase or be in a bond market that's paying much better interest than it was previously. And the outlook might be pretty darn good for bonds going forward and the fixed income markets going forward. While it's been a difficult year, one of the things we've done throughout the course of the year to kind of offset what's happened in the bond market, as we've moved into things like short-term bonds and floating rate bonds and things that are less interest rate sensitive. So we have not lost 16% in our bond portfolios because we have done a very good job of moving into the less interest rate sensitive areas of the market. And one of those areas is managed by Frost and our next speaker, which is one of our short-term bond funds, which has done very well in a very difficult bond market. And I will turn it over to Jeffrey and let him kind of elaborate on what they do, what they see for the future, and what they've been able to provide to our portfolios throughout the course of the year, and why we've brought them in as a partner on our core portfolios for you guys as our investors. Jeffrey, I think you're on here. I want to let you kind of take it away from there, my friend. And Jeffrey. Sorry, guys, hold on. There he is.
Yes, are you there?
We got you, Jeffrey. Thanks for joining us.
No, sure, you bet. Thanks for having me. Certainly appreciate it. This is the first time I've done this with you, and so nice to meet you. And thanks for the time. And hopefully I can give a few thoughts to you and your clients. You teed me up very well, but as an aside, Chris, I'm quite impressed. I don't have any slides tonight, but I'm quite impressed with your slides. I actually will call you later and ask if I can borrow some of your slides. You have some fantastic information there. But yeah, so you teed me up very, very well as it relates to the bond market and the opportunities. And I would certainly agree with you. For the first time in quite a few years, we really are sitting in a position heading into 2003 where the bond market, especially in the United States, is certainly offering some opportunities. So very excited about that. But just for a second, I kind of want to go back to some of the things you talked about in terms of where we've come from, because I think it's certainly important. I should have said this to begin with, but I apologize. Sometimes people say you're a portfolio manager, you speak in Greek. Matter of fact, most of my sales folks won't even let me talk to any clients because they think I speak Greek. I say I don't speak Greek, I just speak Texan. So bear with me on that. But going back in terms of what's happened, you are exactly right. The bond market, really globally, but definitely in the United States as well, has seen really not just a 2022 of epic negative proportions, but really a 2021 that was better, but not that great either. You really need to true back to what was going on during the first half of 2020 when the pandemic started. Obviously, central banks around the world started to ease policy. Interest rates, including in the United States, dropped to historic lows in terms of yields. At one point, the 10-year U.S. Treasury note reached a yield of only 50 basis points. So you talked about just a second ago in your slide that the 2-year Treasury was at around 50 basis points or a little bit higher than that at the beginning of this year. But if we remember back to mid-2020, the 10-year Treasury yield got down as low as 50 basis points. So historic lows. And so you really are working from that period of time. And so 2021, we saw not horrible, but essentially negative returns across definitely the U.S. bond market. I think in the Barclays Ag, that big, I guess it's called the Bloomberg Ag these days, but that big bond market index that you referenced, that so many people looks at, basically produced a return of a negative 1.5% in 2021, and that was fairly bad by historic standards. A negative return for the U.S. bond market only happens, every now and again. It doesn't happen very often. And 2021 was one of those years. So it was already negative as interest rates were beginning to slowly normalize. Well, this year in 2022, you already said it, interest rates continued to go up by even higher amounts, particularly as the Fed started to react to higher levels of unexpected inflation. And next thing you know, to your point on your slide, the Bloomberg Barclays Ag was at one point even down about 16.5% in return at one point in this year. It's now rallied back a little bit. You had 15% through today. It's probably 14%. You had another good day in the Treasury market. But the bottom line is there's really no period of time in history, perhaps back in the 30s, while nothing was really tracked, but you'd have to go back perhaps that far, 1930s that is, to have returns in the bond market as bad as what we're seeing right this second. So really bad returns in 2021. And then so far this year, not just bad returns, but historically bad returns. And so what does all that translate to? What that essentially has resulted in my opinion, and I don't really think it's opinion, I think it's pretty much fact, is that sentiment for investors for bonds has really just been exceptionally poor. In fact, I mean, you could turn on, the talking heads on CNBC or Bloomberg, not here the last month or so, but certainly in the middle of this year. And people are really questioning, why even have bonds in my portfolio? What's the point of them? They're, to your point earlier, they're offering very, very little income. And then on top of that, they're not performing the way they should perform, where they go up when equities go down. In fact, they're going down, to your point, at the same time as equities are going down. So you really had sentiment very, very poor. I think many investors were asking, why even have bonds? And that's essentially where we're working from. So where are we at now? It's been very, very painful, but we're now in a position where obviously yields are higher. The outlook is certainly somewhat better, and I can touch on that. I'll try to keep it concise so I don't run out of time for you. But the bottom line is we've been in a very painful process of what I'd characterize, normalization from essentially the middle of 2020, as the globe was in the middle and the worst of the pandemic, and again, where yields were at all-time lows. And so that's what's been essentially occurring. So now, come full circle, where are we at now? Just give me a second, and let me, because I'm a bond guy, I got to play economist, and that's what I do. I play economist. I'm not a real economist. But largely, many of the things that you actually touched on, Chris, we agree with. First and foremost, there's a lot of economic data that is certainly slowing in the United States, but certainly outside the United States as well. First and foremost, a lot of what are called leading economic indicators are slowing and have consistently slowed for the last 3 or 4, 5 months. One thing that I like to look at quite a lot, and we have access to on our side, is a lot of great information on surveys from corporate America, or corporate surveys. And if you kind of look at the corporate surveys, CFOs and other senior managers of large companies certainly are pretty consistently noting weakness in their businesses over the last 6 or 7 months. Now, on the good side, so far those surveys are not at recessionary levels, and it's probably somewhat consistent with that line that you showed from the New York Fed. But at least the survey so far from CFOs and whatnot, they're heading in that direction. Just some other things, certainly layoffs. Employment's been very, very solid, especially in the United States. Not so much globally, but certainly in the United States. But just really over the last 60 days, we've started to hear some news of layoffs for the first time. I don't really have to talk about housing. I think everyone understands, what's going on with the housing market. But heading into, the pandemic, housing was essentially, 15% more or less, depending on how one wanted to calculate it, 15% of the U.S. economy at least. And so that's a major industry that is certainly weakening and is going to have its challenges with what's going on with interest rates. But then lastly, 2 last points, one on inflation. While inflation is trending, in our opinion, in the right way, in other words, inflation is starting to finally move downward. The bottom line is it's still, by the last 30 years at least, at pretty high levels, and that is certainly slowly hurting the consumer, in our opinion. It's taking time to do that, but the high levels of inflation, in our opinion, are certainly hurting the consumer in particular, as real wages aren't as good as what one would think just by looking at kind of the nominal increases in wages and whatnot. And then lastly, the Fed. You talked about the Fed, but without a doubt, the Fed has started to tighten policy. In other words, increase interest rates pretty quickly, in my opinion, because they were too late in the game in terms of beginning to normalize. And so, quite frankly, we think that monetary policy from the Fed is actually a little bit tighter than what the level of interest rates would suggest. In fact, if you actually look at reserves in the banking system, they've already declined, close to $750 billion. And the supply of money, which economists never talk about anymore, many economists would tell you, growth rates and money supply don't even matter. But if you do put a little bit of merit in that, growth rates and money have certainly slowed as well. In terms of what the Fed is going to do, in our opinion, we still believe, a little bit different than I guess the markets. Now, let me just say in all candor, Chris, if you'd have had me on here with your clients 6-7 months ago, I would not have said this. So in other words, based on where we are today and what our opinion is today, we would have been viewed as wrong because we wouldn't have said 6 months ago what I'm going to tell you today. We thought the Fed would have already stopped hiking rates, basically. But right this second, in our opinion, we think many of the members of the FOMC, especially the ones that matter, are still ultimately somewhat dovish. We think one of their primary focal points, sure, they want to get actual levels of inflation lower. But in our opinion, we think the last thing they want to do is lose credibility. And so until actual levels of inflation move somewhat closer and are certainly trending downward, they're not going to change their rhetoric. But once it's clear inflation is starting to move closer to long-term expectations, and long-term expectations are around 2.5%. So they've gone up about 0.5% versus where they were before inflation spiked. Once they start moving closer in that direction, in our opinion, we think the Fed will quickly pause. I won't say pivot, but will quickly pause. And so what we actually believe is that the Fed will lift money market rates again in 4 weeks to 4.5%. And then once you get into January, and their first meeting is roughly the end of January. Once they get into the beginning of January, get into the end of January for their first meeting, we think the odds are fairly high that they will actually not lift rates again and actually pause. Now, that's opposed to the markets who, at this part believe the Fed's going to continue to lift rates up to around 5%. But the bottom line is we actually think the Fed is closer to at least pausing than what many are expecting. Now, in terms of the actual bond market, what you actually asked me about, I'm already taking too much time, so I apologize.
No, you're good. Yeah, go ahead.
In terms of the actual bond market, I didn't say this, but in terms of a recession, at this point, our base case is that it's essentially a coin flip in terms of, at least in the United States, whether we enter a mild recession or whether we're able to kind of navigate and not quite hit a recession. The fourth quarter actually is looking pretty solid in terms of a growth number, but that's right this second. That doesn't mean what's going to happen early next year. But we think it's essentially a coin flip. And in all honesty, I guess that's a different way of saying we don't want to make a strong call on whether the economy actually moves into recession or not. So that's our base view in terms of recession, not recession. But the bottom line is, and you actually said this or showed this in your slide, the starting point with bonds, yields are now appreciably higher than where they've been really since the great financial crisis. Treasury yields are higher since the great financial crisis. Investment grade rated corporate bonds are up to levels not seen since 2008, the financial crisis. High yield's a little bit different story, but in some spaces of high yield, income levels, yields are up to 10-year highs, 15-year highs, and so as a starting point, we now are at a level where income generation is a conversation point again for fixed income, and so that's fantastic. So just getting right to the point, in our base case expectation for 2023, we think what I'd characterize or call a core U.S. bond portfolio will deliver returns. And sorry, I speak in returns and not just yields. Returns will be somewhere in the neighborhood of about 4.5%. So if you ask me, this time last year, what we were expecting, we were actually pretty negative, and we actually told that to our clients. We were expecting the market to produce a return of 0%. Unfortunately, we were not bearish enough. We're pretty bearish, but we weren't bearish enough. But now at this point, as a starting point, yields are higher. To your point, the economy is weakening. We can debate, recession, not recession, but it's, we're in a position where there's a fairly significant probability that fixed income will produce returns around 4.5%. And then my second to last point, I guess, is if we're wrong in that call, we think the risks are skewed slightly towards the recession will in fact ensue. It'll be worse than expected. And then at some point in 2023, the Fed won't just have to pause, they'll actually start to cut, and you'll actually get a rally in treasury yields. In other words, treasury yields decline. And so if we're wrong, we think the skew is that that will be the scenario as opposed to a continuation of the sell-off. And so, the bottom line is our base case scenario is fairly attractive for the first time in a while. And then if we're wrong, we think we'll be wrong in the direction where returns will actually be higher than our 4.5%. Lastly, and going back to one of the things I said, it's not in the numbers yet. You can't see this. If I run for your clients a correlation between the S&P 500 and the treasury market or just the bond market, or if you go and do it, you won't see this in the data yet. So this is our opinion. But in our opinion, we think now the bond market is much better positioned to be that diversifying asset class, where if stocks continue to sell off, that we think instead of bonds selling off at the same time, at least high quality bonds like with treasuries, we think for the first time in a while, the bond market will actually start to rally in that situation. So in other words, if stocks continue to sell off, we think, unlike what's been going on, we think it's going to change and bonds will at least start to rally. Again, high quality treasuries, things of that nature, not the high yield market. The high yield market for a while will continue to be highly correlated to the direction of stocks. And so we're really very positive from the perspective of, we think now's, for the first time in a while, is a good time to invest in fixed income, and hopefully it will deliver that diversifier for the stock market, just in case stocks continue to go down.
Love it. Excellent. Yeah, I appreciate that very much, Jeffrey. That was you should be allowed to talk to more clients. I think you did an excellent job. I don't think you talked whatever you called it, economic talk or over anybody's head at all. I really appreciate the info. I think it was well delivered. I will just say to my clients that are listening, Jeffrey and I we did not prepare for this. We did not talk beforehand. This is the first time we've ever talked. And the reason I point that out is a lot of what you're saying, Jeffrey, is a lot of what I'm talking to my clients about. And where we see interest rates going, where we see the Fed going, where we see inflation going, the opportunities that it presents, and where we see the bond markets going. So you, without us communicating ahead of time, reiterated a lot of what I have been kind of telling my clients, which I appreciate that. Means that they don't think, at least there's another guy out there that, knows what he's talking about. But I want to go back to something you said, and I just want to make sure that everybody listening clearly understood what you said. And it goes back, I'm going to go away from your beautiful picture there, Jeffrey, and I'm going to go back to this right here. What Jeffrey said, if you're listening, is that if things do well, they're thinking bonds do 4.5% next year. If things do bad, if we go into a recession that is a deep, damaging recession, which I'm not necessarily in that camp, but if that's the direction it goes, and if anything's possible, and we go into a deep, damaging recession, we run the risk of the Fed needing to pivot a different direction and start to stimulate the economy and dig us back out of it. And the way the Fed would do that is to lower interest rates, like they've been doing previously to try and stimulate the economy. And so if you heard what Jeffrey said, he said 4.5% for bonds in a good market environment. If things go bad, the Fed could actually need to stimulate the economy and lower interest rates, which, as you see on this chart, would drive bond prices higher. So what he's saying is you're going to capture your 4.5% or your whatever it is, let's call it a 4% yield, and you potentially get appreciation in the value of your bonds based on the Fed having to lower interest rates in that recessionary environment. So 4.5% in a good year, more than that in a bad year, which is essentially what bonds are designed to do in a diversified portfolio. Is when things get bad, recession sets in, bonds are supposed to support the other half of your portfolio in that market environment, which is what they were designed, or not designed to do, but what essentially we want them to do in a diversified portfolio, and essentially what we think they could be doing in the future. God forbid things get bad and we do go into that nasty recession sometime next year. So that again goes back to what we were saying, is that bonds have a place. Bonds have not been exciting to me, even as a financial advisor, for quite some time now. Low interest rates, not a lot of opportunity. Stock market has been booming, so let's buy stocks, right? But bonds right now, for the first time in a long time, really look like they present opportunity. They present a hedge against the stock market or a hedge against a recessionary environment. They're doing what they're supposed to be doing from an investment portfolio management standpoint, which we think, if you've overlooked bonds in your portfolio in the past, is why you should look at them a little bit more seriously going forward as a very viable piece of the overall allocation of your portfolio. So so Jeffrey, again, I really appreciate you kind of reiterating all of that and giving us your insight.
You bet. Thank you. Thank you for having me.
Yeah, no, and thank you again. For those of our clients that own our core portfolios, because a lot of our clients own a lot of portfolios here. We have some stock portfolios, and we have some what we call our core portfolios. In our core portfolios, you have some Frost mutual funds in there that fill some of our fixed income segments of the portfolio. And just again, Jeffrey, thank you. Our Frost funds have done well this year in the face of a very difficult bond market. And so we appreciate what your funds have done for our clients. And so thank you there. And then I banged on the table, so I'm just going to give a shout out to Brooke, who tells me during these things to stop banging on the table because it shakes the camera. So sorry about that, Brooke. But other than that, everybody, I hope you enjoyed the webinar, and I hope you guys have a great rest of the night. If you have any questions or you want any additional information about anything that we've talked about, please do not hesitate to reach out to myself, Brooke, or any of the other members of Prosperitas. We're happy to answer any questions that you may have. And if we don't talk to you soon, have a great holiday season. And keep in mind, we do have a Santa Claus event here at Prosperitas coming up. I should have the date in front of me. I want to say, I wish I had the date in front of me. I want to say December 2nd. I'm guessing though, but we are going to have Santa Claus here in the Prosperitas offices for you to come with your family, take some pictures with Santa, have the kids I'm sorry, Brooke just texted me. It's December 1st. December 1st, 5 to 8 p.m. in our office. Santa Claus is coming to Prosperitas. Bring the kids out, take pictures with Santa Claus, make sure they tell him what they want for Christmas. And we're going to have an ice cream truck and some other fun activities for the kids. And we would love to see you all here in the office and celebrate and kick off the holidays. So that's it. That's all for me tonight. I kept it within an hour, I think. So we did a good job tonight, much better than we did on the last two. So again, Jeffrey, thank you very much. And I will see you all very, very soon.